I think the key for this year will be the Fed either overtly or covertly, or just by jawboning, instituting some measure of yield curve control.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today, Craig Hemke from the TF Metals Report. Craig, great to see you and glad you're feeling well.
Hey Elijah, nice to see you again. It's funny, the last time we did this was back on December the 9th, I think. And that was the day I actually took a COVID test that was positive. And I just was back watching that video. I looked like I was sick that day. So I'm glad to report that, I'm all better. I wouldn't wish that on anybody. That's not much fun. And, Elijah, it's really kind of concerning as you go through it. You're a little unnerved the whole time. So anyway, I'm glad it's over. It's nice to see you.
Yeah, it's so nice to see you. And I'm so glad, you've recovered. And that's great news. I'd love to discuss regarding your forecasts for the 2021, right? You've talked about how really you see gold and silver rising again, and really gold rising kind of the same rate it's risen the last 2 years, about 20%. Can you expand on that?
The easiest thing I suppose would be, 20% plus or minus something, but that's just kind of the round number that I thought I'd go with. And I'm pretty sure we're not going to get there the same way we have the last couple of years, where we've rallied for the first 8 or 9 months of the year and then, put in our highs and then pulled back and consolidated into year end. That may still happen. But the way this year is shaping up, as unpredictable as it is, wouldn't it all surprise me if we just flip that script entirely, and maybe go sideways for another 3 or 4 months and then rally into year end. And if I'm right about what the catalysts are that will drive prices higher ultimately again this year, that may be the case. But you're right. I do these annual forecasts. I don't know why. I guess I got started doing it because a lot of people do. And so about 4 or 5 years, TF Metals Report's now been around for over 10 years. And so about 4 or 5 years ago, I started cranking out these reports in January just for fun. And the last couple have been, luckily, fortunately, whatever, because you're predicting the future. It's like predicting the weather. Last two have been really good, but that doesn't really matter, right? It's like, what have you done for me lately? And when you put a forecast out there on a year in advance, all you're really doing is opening yourself up for the trolls, because if you get it right, it's like, well, anybody could have seen that coming. You're not special. And if you get it wrong, then, people point back to that for years to come. And plus, actually, I found out again this year, even if you get it right, I look through comments of stuff and people are like, yeah, that guy's hasn't been right for 10 years, all that stuff. And I'm like, did you read last year? So there's not a lot of upside, but it does give us kind of something to follow along as we go through the year.
Now, you mentioned in the article that you see $2,300 gold and $38 silver. Those are kind of the price targets for this year. You mentioned that you're looking for maybe that to happen the second half of the year. What are some of the catalysts that could really push gold and silver to those prices?
Well, let's take that. Let's take gold first, and remind me. We'll come back to silver, Elijah. The challenge sometimes, it's like predicting Bitcoin from here. You're off the chart, right? When you're in an area, or Tesla, whatever, anything that's moving to new all-time highs all the time, you're just kind of guessing as to where it might peak out. Some people use Fibonacci levels and things like that. When you have a history and you can see the old like in silver, you can look at the chart from, last run 2009 to 2011, maybe guess where there might be some resistance points and give you some targets. But gold, you don't have that. So what I did, where I came up with 2,300 isn't just like pulling a number out of my ear. There's two things that I thought made that seem logical. One, in the last 7-year bull market from 2005 through 2011, the average annual gain, if you just even including 2008, the average annual gain was just north of 20%. We finished the year at 1,900, so you add 20% to that, and you get about 23, right? The second part of this is that it has been my experience and all my time as a stockbroker beginning, 30 years ago, and watching markets, watching individual issues, equities, whatever, commodities, you name it. When you exceed an old high, especially an all-time high, that always generates a lot of publicity and excitement. You get some kind of late running froth come into it, because it's in the headlines and people are like, wow, look at that. It's moving to an all-time high. And I kind of on average, my rule of thumb has always been you're going to overshoot then by 10%. It worked last year, actually. The old all-time high in gold was 1920. We went to 2080 or 2100. That's like 9% before pulling back. Well, again, our new all-time high from August is 2080 or 2100. If you add 9-10% to that, there's 2300 again. So I thought that seemed logical. You asked me about catalyst. What's going to do it? Because this, I know I'm, pulling my hair out. This last 4 months is driving everybody crazy. It's really made people crazy since November because since the middle part of November when gold was looking to break out, and then it got smashed with the Pfizer news and continues to go lower, but everything else has gone up. All the commodities, stock market, real interest rate, things like the tip have gone up. Everything's gone up, and the dollar's gone down since early November. About the only thing that hasn't gone up is gold. It's like, so what's going to break us out of it? I think the key for this year will be the Fed either overtly or covertly or just by jawboning instituting some measure of yield curve control. You know how, Elijah, you ever heard the term the Fed put in terms of like the stock market?
Yeah, actually, yeah. And I'm interested to know exactly what that is referring to.
Yeah, well, it's this notion that if the stock market were to decline, the Fed would loosen policy, and pump it back up. And so it allowed you to always kind of feel like, well, I got the Fed behind me here. Don't fight the Fed, and so on any drop of 10%, hey, let's buy the dip because the Fed's not going to let it fall any further. Well, I think that's what's going to play out in the bond market this year because what really changed everything and what allowed me to get bullish and start making these correct forecasts in 19 and 20 was the Fed had kind of spun the plates as far as they could in 2018. For the 5-year period, they'd played this game that they were going to normalize interest rates, whatever that meant, and normalize their balance sheet, whatever that meant. I mean, it was never going to happen. But they backed themselves finally into a corner where the 10-year note yield got over 3%, and they'd shrunk the money supply, and everything began to collapse. And it was at that point they began to pivot. In June of 19, they officially changed their monetary policy and started easing. And this is all when real interest rates started to go negative and gold has been rallying ever since. And so they know they can't let interest rates go past whatever certain level. I'm sure they have a level in mind. I thought maybe it might be 1%, maybe it's 1.5%. They know it certainly can't go to 3 again. And so the Fed wants to inspire inflation. You hear that all the time, right? You hear Powell talk about, we have this inflation target. We're actually let go to 2% or even 3% before you have to worry about us raising the Fed funds rate. So they want to have inflation, but a lot of times you get higher long-term interest rates with that if you get inflation, but they don't want that. They need to hold long-term interest rates down. We've seen the yield on the 10-year note go from about 55 or 60 basis points, which is 0.55% or 0.6%, all the way up to today's 1.1%. I mean, that's almost doubled. And that's a big part of what has driven gold backwards since August. Eventually, though, the Fed will either formally or informally put this put on interest rates. Okay, so here's what I think will happen, Elijah. The first thing they'll do, and it may be as soon as 10 days from now when the January FOMC concludes, there's going to be, some notations in there, or there likely will be in their statement. A number of participants were wondering if we should shift the maturities that we're buying in our QE program. Because currently they're buying less than 1-year maturity T-bills and really short, like 2-year notes. But if they keep the number the same, or even if they cut the number, but they started buying more 7-year and 10-year and 20-year, 30-year bonds, then that's the first step in saying we don't want interest rates to go any higher, and we stand here ready to buy bonds if rates, at a certain level. If that doesn't stop, those longer-term rates from rising, because again, they can't have that. All the public and private debt, you just can't have higher level of interest rates. You start spinning the drain ever faster. So if that doesn't work, if they can't jawbone that, then maybe by March, they'll actually announce that they're extending, the maturities that they're buying. If that doesn't work to actually cap rates, then by June, they may come out and say, as we've done in the past, and they did this back in the 40s and 50s when debt to GDP got to levels not even where we are now. They'll come out and they'll say, all right, for now on, we are a buyer of treasuries anytime the yield gets above what? 1.25%, 1.5%, whatever. We're going to buy 10-year treasuries. And there's your put. There's every bond buyer, bond holder in the world goes, well, anytime we get up near 1.5%, I know the Fed's going to be there, so I'll be buying. So again, now the Fed still didn't have to do anything. They just had to say it. And then maybe if that doesn't work, then maybe deeper in the year they actually. But anyway, to follow along with this, by capping longer term interest rates, specifically the 10-year note, which is the benchmark. And then as interest rates go up, the real return, the inflation adjusted return goes more and more negative. Oh, sure, you might get 1.5% interest on your 10-year note, but if inflation's 3%, you're actually losing 1.5% in purchasing power. It is those negative real interest rates that have always been the most strong fundamental driver for gold prices. It was negative real interest rates and the stagflation of the 1970s that caused gold to move up 8-fold in 4 years. And it'll be the driver this year. And the only question is, and I'm sorry for the long answer, but in trying to lay all this out, the only question is, how long will it take, for these gradual steps that the Fed is going to make to play out? And that's why I said maybe this year will be opposite of the last couple of years, kind of sideways and flat, in a range for the first 3, 4, 5 months, and then, really up at the end once this policy's in place.
And as we see in the last couple of years, and as we've seen when gold rises, silver normally rises faster. And you're predicting a $38 silver price, which is pretty high from where it is right now, around $24, $25.
Yeah, it would be versus the high last year, another 20% on top of that, from 30 to 36-ish. And you can, like I said, you got a chart. We can look at the chart and predict where there's going to be resistance, and where you might top out on an intermediate term basis. But the other part of this, though, Elijah, is a falling dollar, which I think probably continues, not straight down, but the trend probably continues lower because the Fed wants a lower dollar. They're trying to spark inflation. And one of the ways you can do that is with a less valuable dollar versus all these other currencies. But you can see this in general commodities. You probably have had some guests on, or people that are on Twitter have seen some charts of like the continuous commodity index or the Bloomberg commodity index, long-term monthly charts that show a breakout, from either a downward trend or a downward wedge. We may be on the early stages of a pretty good commodity bull market. Silver is considered a commodity. It's not, you and I think of it as a monetary metal, but the rest of the world thinks of it as a commodity and an industrial metal. So if copper and crude oil and zinc and aluminum, and you name it, nickel, whatever, if they're all rallying, silver's going to get a bid too. And then finally, what's really unusual is that other mainstream, is that a fair term? Mainstream analysts are noticing this. A lot of major investment houses and kind of research firms are touting silver as a great investment. With like my 38's conservative compared to what I've seen. Morgan Stanley or Citigroup or Goldman Sachs. You go around, you name it, they're talking $40 to $50 silver. So for once, I'm not like the crazy guy, the pumper talking about higher silver prices. This is kind of a mainstream view, and that kind of sometimes becomes a little virtuous cycle, self-fulfilling thing. Because if that gets people to buy and hold, then all of a sudden you start making new highs versus last year, and the more people get excited, and then they start researching it, and they find these $38 targets, and they think, wow, So that can kind of be self-fulfilling too sometimes. So anyway, that's why, I expect gold to go up based on these negative real interest rates, falling dollar. That spills over into silver, general commodity run, and I feel like, yeah, we could easily move up to something in the high 30s at some point this year.
We saw last year that it was just a crazy year on all levels. And do you think that 2021 is going to be similar? It's really going to be a wild ride. It's going to be wildly unpredictable. Can you explain for our viewers kind of what you think is driving this uncertainty, this unpredictability? What are kind of the fundamental factors in your mind?
Well, besides just on a sociology, I guess is the word I'm looking, standpoint, if anybody hadn't read The Fourth Turning yet by Strauss and Howe, it might be a good one to pick up and read through, that we're in that fourth turning 20-year generational period where there's all sorts of upheaval. And yeah, it sure works that way. And you think I saw a thing on Twitter over the weekend. Somebody said, okay, I've had my 7-day trial period of 2021. I'd like to cancel my subscription, please. Because, look at what's already taken place. Things that you never thought you'd see, in your lifetime. And so, yeah, this is that's what this forecasting business makes it so difficult, because you can be right about the big picture, and I'm pretty certain about the math and servicing the debt and servicing the deficit, another $2 trillion in deficit spending that Biden wants to get passed in his first 100 days, all that kind of stuff. That money's got to come from somewhere. It's not coming from existing dollar reserves around the planet. The Fed's going to have to create it. So I can be right about the big picture, but all this, there's all this crazy stuff going on in the world, and so maybe prices don't go higher this year, even though the big picture continues to deteriorate. And so I guess that's mainly my primary focus since the macro stuff is so hard, the non-market events, are impossible to predict. I just want to keep focusing on the big picture. We're going to cross $30 trillion in debt at some point in the next few months. Again, running at least a $3 trillion annual deficit by the time the fiscal year ends on September 30th, probably more like 4 or 5. And this COVID thing, the damage is done. This notion that there's some V-shaped recovery and we go back to where the economy was in January is crazy. Even with the job recovery that we saw May through October, we're still down 10, 12 million jobs by the BLS's estimate from where we were in February. And again, those jobs aren't coming back. And so I think, you factor in that, you factor in the economic damage. Think of all the businesses out there that have decided if they have traveling sales force or customer service people, well, we don't need them travel anymore, at least not as much. We can do that. Everybody's gotten used to doing that by Zoom. Or the people that are like, why do we have 10,000 square feet office space in that building when we could easily get by with 5, and let everybody work from home? This is working just fine. We're doing just fine. We're more profitable than ever or something. And so all of a sudden you got a commercial real estate crisis and a commercial mortgage-backed securities crisis, and there's all these different houses of cards out there. And so I just don't see the math ever getting better in terms of the sustainability of the system. And, you're just going to have these central banks throwing more and more money at it because they're limited in what they can do. And all of that ultimately, is going to make my gold and silver that much more valuable. But the hard part is, again, like any bull market, that bull is going to buck and jump and kick and do everything it can to throw you off. But if you're going to win, you got to ride all the way to the bell. And so maybe that's the best thing I can do for everybody at TF Metals Report this year is just to keep them on the bull, all the way to the bell.
And you've mentioned, it definitely is going to be a wild ride no matter what. And one of the things that's kind of interesting is, especially with mining stocks, you often see a greater gain and also a greater loss when prices go up and down. What are your thoughts on mining stocks this year? I know in the article you mentioned that you're expecting quite a big gain.
Yeah, I was last year too, Elijah. That's what's frustrating. But yeah, I thought last year would be I called it outsized gains because you have leverage there, right? I mean, if a company is making, a certain amount of cash flow or even earnings per share at $1,500 gold, well, their costs haven't gone up that much, and now they have $1,900 or $1,800 gold. That's a lot of extra cash, and a lot of these big producing companies have plowed that into share repurchase programs and reinstating or increasing their dividends, and all of these things should be good for prices, and it should be as a value investment with growth. But versus something that's just totally speculative in nature, like a Tesla or an Amazon or something, that you would think that would come into favor. It just hasn't yet. Even institutional money is chasing, there's just maybe 10 or 12 S&P names, and that's what keeps driving the S&P 500 higher. I still think a day will come when the shares will get an institutional. I mean, when I say institutional, I mean like hedge funds and pension funds and, the really big money. Day will come when people want to diversify into some of these things with great growth, especially as gold keeps going higher. And it won't take much cash, right? You could buy the entire mining, the top 10 mining companies for $30 billion or whatever. I mean, it's nothing. A fraction of what Apple is trading at total market cap. I just haven't looked to see what the actual numbers are. So if you get suddenly an influx of cash and the shares start breaking out, and you even get some of these day traders to start playing in them, they could go up really, really quickly. Go back to 2016, Elijah, as an example. When we broke down, I remember the date, it was January 19th, 2016, the Hui index broke down below 100. And I mean, everybody was freaking out. It's down to 99, got to 99.19, and everybody thought it was going to 60. Well, that was a low. And that index more than tripled from there, or about tripled, I guess, over the next 8 months. And if you weren't still holding on at the low, and then you get chasing and you wait for a pullback and all this kind of stuff. And so, yeah, the mining shares are frustrating. But if I'm right about the metals, then all the mining companies, or most of them, are going to continue to make more money, going to continue their share purchase programs, going to continue increasing their dividend. And I think at some point that light's going to go on, and the floodgates are going to open a little bit. Some cash is going to flow into the sector, and things are going to go up pretty fast. And that's why, and I want to make sure I'm there for that. And so I own all the shares I've held. I've held them all through. I mean, I haven't made significant changes to like my IRA. That's nothing but mining shares. Everything's basically the same as it was in August. Maybe that's just lazy. I guess, you could hedge and all that kind of stuff, but I just figure I'm in that for the long haul. And that's, I think, probably the best strategy if you can afford to do it.
Awesome. Well, Craig Hemke, thank you so much for your time today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yes, sir. tfmetalsreport.com. It's a thriving community of a couple thousand people from around the world, all different political stripes. Thankfully, we're almost through the political season because as much as we try to not let it be divisive, this has been a particularly divisive political season. But there's people, like I said, from around the world and every political bent. But what we all recognize together is that we're in this together. I mean, it doesn't matter if you're a Republican or Democrat or Labor or conservative or whatever. I mean, the monetary math and the monetary system is the same for everybody. And so we've got to prepare for how the system is changing and where it's likely headed. And so the site is, I think, very helpful in that regard. And then I do analysis every day of overnight events, and then a podcast at the end of the day, kind of giving you a summary. I'm kind of everybody's eyes and ears to the world, so you can go about your business and then just check in from time to time, and I'll let you know if anything major is going on. For that, it's $15 a month, 50 cents a day for me to be your eyes and ears, probably a pretty good deal. And you can find all that at tfmetalsreport.com. I encourage people to check it out.
Well, Craig Hemke, once again, thank you so much for your time, and God bless.
Hey, God bless you, Elijah. Keep going. You're doing a great job too. I appreciate it.